VA loans are government-insured mortgages designed for eligible veterans, active duty service members, and certain surviving spouses. They were created in 1944 as part of the GI Bill and are overseen by the U.S. Department of Veterans Affairs. Since their inception, the VA has insured over 20 million home loans, and to this day, VA loans consistently have the lowest default rates of any major mortgage program. There's a lot we could cover about VA loans, but in this video, I want to focus on why VA loans are so powerful and what you need to know to use them correctly. One of the most well-known features of a VA loan is no down payment requirement. For most borrowers, this applies to first-time use of VA benefits or full restoration of entitlement. You can use your VA benefits more than once, even if you currently have a VA loan. Whether or not a down payment is required depends on how much remaining entitlement you have available. VA loans are for primary residences only. VA loans typically offer lower interest rates than conventional loans, and unlike FHA or conventional financing, VA loans don't require monthly mortgage insurance, regardless of how much or how little you put down. Instead, VA loans have a one-time funding fee. The funding fee amount depends on whether it's your first time using VA benefits, whether you're putting any money down, or whether you have a service-connected disability, which can fully exempt you from the funding fee. The funding fee is usually financed into the loan, but it can be paid out of pocket if you choose. We determine eligibility entitlement and funding fee exemptions by pulling your Certificate of Eligibility, or COE, directly from the VA. The borrowers with full entitlement, there is no VA loan limit. That means you can finance 100% of the purchase price on a single-family home, condo, townhome, or 2 to 4 unit property. VA loans also allow seller concessions up to 4% of the purchase price. These can be used for closing costs, prepaid expenses, funding fee, and even paying off debts at closing. Seller concessions cannot be used towards down payment, but in some cases, borrowers can walk away from closing with little to no money out of pocket, and occasionally even get money back. One of the most important and most misunderstood parts of VA underwriting is residual income. Residual income looks at after-tax household income, housing expenses, monthly debts, and child care costs if applicable. The remaining amount must meet a minimum threshold, which varies by household size and region of the country. This is something I see mishandled by lenders far too often. If residual income isn't calculated correctly up front, it can derail a loan late in the process. Another key point, in community property states, a spouse's debts must be included in the analysis, even if they are not on the loan. Their income can offset those debts, but this must be documented properly. VA loans are extremely flexible with debt-to-income ratios. It's not uncommon to see VA loans approved with DTIs well above what conventional loans would allow, even into the 60% range in some cases. That doesn't automatically mean the borrower is overextended. Often, a spouse has income, but it isn't on the loan. The household's true cash flow is strong, and residual income requirements are still met. This is why VA loans evaluate risk differently than other loan programs. Technically, the VA does not set a minimum credit score requirement. However, individual lenders will have their own minimums. VA loans are also among the most forgiving when it comes to prior credit events. For bankruptcy, it's 2 years from discharge. For foreclosure, it's 3 years from the date of sale. There are also extenuating circumstance exceptions evaluated case by case. Keep in mind that if you had a VA loan in the past that was part of a foreclosure, your entitlement may not have been restored. Like FHA, VA loans have minimum property requirements related to safety and habitability. Common issues include peeling or chipped paint, missing handrails, and safety hazards. If the VA appraiser notes an issue, it must be repaired before closing. Despite the reputation, these standards are about basic livability, not cosmetic perfection. VA appraisals offer one of the strongest buyer protections in the industry. If a VA appraisal comes in below the purchase price, the VA may issue Tidewater. This allows the lender 2 business days to submit additional comparable sales, which are typically provided by the real estate agents. VA appraisals are also ordered directly through the VA, required to be completed within 10 business days, and valid for 6 months and tied to the property. If a VA appraisal is completed and the deal falls apart, a new VA buyer must use that same appraisal within the 6-month window. If you're refinancing a VA loan into another VA loan without taking cash out, you may qualify for a VA IRRRL or IRRRL, which stands for Interest Rate Reduction Refinance Loan. These typically require no appraisal, minimum documentation, and a mortgage-only credit report. They're designated to reduce your interest rate or payment with ease and very little friction. VA loans are one of the most valuable benefits available to veterans and service members, but they need to be structured correctly. When used properly, they offer no down payment, no mortgage insurance, flexible underwriting, and strong appraisal protections. There's much more we could cover, but this should give you a solid foundation. If you found this video helpful, please consider subscribing and following us on social media for more clear, practical mortgage education. Thanks for watching.